Hi guys, welcome to a past question a day. My name is Shadrach Opoku Frimpong, and today we'll be looking at some few questions. So Solene is a Ghana-based manufacturer and retailer of ice cream and frozen dairy products. The company had a license valued at 4 million in its draft financial statement on 30th June 2025. The license was purchased on 1st July 2022 for 10 million. So 10 million is the original cost and it was purchased in 1st July 2022. But as at 30th June 2025, the value we have in our books is 4 million. Amortization has been charged for each year to 30th June 2025 through the cost of sale. A clause in the contract allows the licensor to withdraw the license with no compensation if certain financial health measures are not maintained to protect its brand. Despite the refinancing, the company failed these measures in the first half of 2025, and the licensor notified the company in May 25 that it would indeed withdraw the license. You have to remember we have the value of 4 million sitting in our books. So if the licensor is withdrawing the license, then we may have to do it, write off the 4 million. Let's proceed. So for tax purposes, allowance for the cost of the license are allowed on straight line basis over the 5-year period of the license. The tax allowance for the cost of the license are unaffected by the withdrawal of the license. Required. Explain the financial reporting treatment of the above transaction in the books of the company for the year ended 30th June 2025. This is a bit easy. We already have the value of the license in our books. It has been amortized over the period and we now have 4 million sitting in our book. So if the license has been withdrawn, then it means the value that we have in our books needs to be written off. So solution is debit and credit. Now we are writing off an asset. So our intangible, 4 million, and we are going to debit our profit or loss. Profit or loss statement, also 4 million. So now the value of the intangible assets or the license in our books has been taken off because the license has been withdrawn. Let's move on to the next question. So Joe is a food and beverage company with a strong presence in Africa, known for its popular brands like cowbell milk and onga seasonings. For the year ended 30th June 2025, the inventories shown in the company's draft statement of financial position was at a cost of 54.2 million. The inventory count revealed 2.2 million, that is at cost, for out-of-date inventories that could no longer be sold and will be disposed of for no income. An additional cost of 40,000 will be incurred to dispose of these inventories. Inventory write-down are not tax deductible when the inventories are sold or scrapped in the tax regime in which the company operates. So required. In accordance with IAS 2, inventories recommend the accounting treatment for the above transaction. This is also simple. We have inventory costing 54.2 million sitting in our books, but out of this value, we have 2.2 million that has gone bad, and we cannot dispose it and get any income at all from it. So we have to write off what? 2.2 from our inventory. So we are going to credit our inventory, our closing inventory sitting in our balance sheet, and we are also coming to recognize it in what? Our profit or loss. So we'll follow suit. So B, we are going to debit our profit or loss statement of 2.2 million, and we are going to credit our inventory in our balance sheet, also 2.2 million. The next one. So C, IAS 37, provisions, contingent liabilities, and contingent assets set out the principles for recognizing and measuring provisions. IAS 37 requires that in cases where the time value of money is material, the provision be measured at what their present value at the reporting date. Yonto PLC has an obligation to restore a site following the completion of mining works currently underway. The estimated cost of these works is 30.225 million, and the works are expected to be completed on 1st April 2034. The present value of the restoration cost was recorded at 14 million on 1st April 2024. The company's cost of capital is 8% required. What adjustment should be recorded at 31st March 2025 to ensure the provision is correctly accounted for in the company's books? So this has to do with the issues of time value of money. We would have to incur 30 million at 1st April 2034. But the present value of this 30 million, the amount that we have to incur in 2034, is actually equivalent to what? 14 million in 2024. We have to incur 30 million in 2034. But the present value of this 30 million in 2034 is 14 million 2024. So each and every year we have to compute something sort of like an interest just to make up for what? The time which we will be accumulating to the present value, so that by the time we get to 2034, this 4 million would have increased to match up with what? The 30 million. So what we are going to do is to pick our 40 million and multiply it against the company's cost of capital, which is going to give us 1.2 million. So what we are going to do is to increase our provision by 1.12 million for the year. So our double entry C, our double entry, we are going to debit our profit or loss that is under our finance cost with 1.12 million, and we are going to credit our provisions in the balance sheet. So balance sheet 1.12 million. So every year we are going to increase our provisions till it finally matches up to 30 million. Okay, so Tani Entertainment is a Ghanaian record label founded in 2006 to provide services in artist management, music production, film and television production, event management, and brand partnership. It has entered into the following transaction during the year ended 31st July. So on 1st August 2024, the company acquired an exclusive right. So we have our intangible asset. So we are going to recognize our intangible asset and we are going to amortize it over the 3-year period in our books. So recognition of intangible asset. The second one, on 1st August 2024, the company commenced work on promoting the brand and developing sales of the digital set-top box. This effort was hugely successful and the company's brand became massively popular and well known. The company wishes to include the brand in its financial statement for the year ended 31st July 2025 at its estimated fair value of 12 million. The organization built their brand and they are just trying to attach monetary values to it and include it in their financial statement. But what is IAS 38 saying? So IAS 38 says that internally generated intangible assets, especially like the brand, should not be capitalized. And this is because it doesn't meet all the recognition criteria stated under IAS 38. One of these criteria is that the asset should be separable, meaning we should be able to separate the brand from the organization. And even to a very large extent, we should be able to sell the brand without necessarily selling the business. Is the brand separate from the organization? The answer is no. So all the expenses we have incurred in building the brand or promoting the brand is going to be treated as an expense rather than being capitalized in our financial statement. The company wishes to replicate its Ghanaian success in other countries by selling the product into other markets. The company has spent 500,000 during the year researching the West African market and wishes to capitalize this expenditure as an intangible asset. Once again, we will also look at guidance from IAS 38. What is IAS 38 saying concerning expenses incurred during the research phase and also the development phase? This is clearly an expenses incurred on just the research phase. So IAS 38 says that any expenses incurred in the research phase of a project should be treated as an expense and it should not be capitalized. So this 500,000 Ghana cedis is going to be treated as an expense in our profit or loss statement and not to be capitalized in our statement of financial position. E. In accordance with IAS 21, the effect of changes in foreign exchange, distinguish between functional currency and presentation currency. So basically, functional currency is the currency of the primary economic environment in which the business or the entity operates. What it means is that if the organization finds itself in Ghana, then the functional currency of the organization is going to be Ghana cedis. If the organization is situated in Nigeria, it's going to be Naira. If the organization is situated in US, then it's going to be dollar. So basically, the currency of the country in which the organization is situated. Presentation currency. So presentation currency is the currency in which the financial statements are presented. So if the organization prepares its financial statement in cedis, then the presentation currency is in cedis. You can be situated in Ghana, which is having your functional currency in cedis, but probably you may want to prepare your financial statement in dollars because maybe you want to give it to your parent company in US. It's also the same way you may have your functional currency being Naira, but you may prepare or present your financial statement in cedis because probably you are reporting to a stakeholder who is in Ghana. Thank you.